Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of New York and London sugar markets. I'll start with ICE raw sugar in New York. The core of the bullish support here for the last few months has been the lower time of the December 2020 to April 2021 bullish shift pitchfork, currently at 1789. I've highlighted the whole pitchfork in blue so you can visualize the times more clearly, as they will become more important with regard to the last few weeks' actions. My only shortfall is that my camera image partially obscures the lower time. But anyway, this lower time caused some very prominent rises in the market, most recently in late October, going into November, that saw the market gap higher and push up over all the moving averages, plus the significant February 2021 high at 1894. The congestion also at 1964, and finally the middle time of the same big bullish shift pitchfork, currently at 2013. Prices peaked at mid-November at the congestion at 2047, last seen capping the market back in April. Separately, I had also previously highlighted the August and November bull channel in red to help visualize this as prices punched up and closed over the upper bull channel line, currently 1886, also back in early November. The reason for highlighting this is that I had also detailed some potential targets topside for this pattern. Thus we had an initial target in the 1990 area and a secondary harder to reach target in the 2020 area. The market's rise reached up all the way to the secondary harder to reach target in the 2020 area. Yet the market did not sustain this seemingly strong move higher, dropping by the middle of November all the way down to just short of the late October to mid-November 50% Fibonacci line at 1902. Before bouncing up 2 weeks ago from a pipe bottom. I was curious last week on what this very recent action might amount to. I saw, back then, that the whole late October to date action could be a bullish halfway hesitation, in which case we might see a resumption of the move higher. We could even have a possible bullish halfway hesitation with potential right off the top of my daily chart in the 2190 area. Alternatively, I also saw that if the market moves up but fails again at, say, the 20.5 area, dropping back downwards, the market could form a double top, with all the opportunities that might present. Back then it was a little early for either of these ideas, and I of course speculated that something else might present itself in the meantime, such as the possibility of the last 2 or 3 weeks being a bearish cat's ears pattern. I decided a week ago that we would have, and I quote, "wait and see how any of this develops, as I suspect the market has not yet made up its mind," end of quote. Well, a week on and nothing much has developed other than I think the short-term idea of a cat's ears pattern is off the table. Nothing is still very clear. The market still spends a lot of time around the congestion at 1964, and though we have had a golden cross of the rising short-medium moving average, currently 1891, moving up over the slower long moving average, currently at 1882, a lagging indicator, the situation is not settled other than the market seems superficially comfortable going sideways around the 1964 congestion. This is despite today's action to move lower. ICE Europe white sugar in London. Changeovers produce some strange events here. Since mid-September, this market has been dominated by one action, the changeover gap that happened back then. One can say a lot of things about what happened beforehand, but that changeover gap here, seen on a continuous daily chart, is really big. There has been a number of attempts since, initially tepid in September, but more active in October and November to try and fill it. The latest attempt made some great strides in filling in the gap, but it ran short because of another changeover. It ended up with an island top and another gap between 552.80 and 561.30. We've since then seen prices fall away on the daily continuous chart below all the moving averages. Yet we've also found that prices don't like being down there either, with some interesting support from the 50% Fibonacci line of the July 2021 to September 2022 move at 522.80, and that was 2 weeks ago. This has to be honest left the whole situation a bit up in the air, last week as well as this week. We seem to be going sideways as between the support of this 50% Fibonacci line and resistance overhead from the flatlining medium moving average, currently 544.60, and slowly rising long moving average, 546.10, well, the market went batting back and forth, recently to a sixth countering intraday pattern. Even today, we are still in between these two forces. The capping March 2017 high at 548.70 and the 50% Fibonacci line below at 522.80. Nothing has been sorted out as we enter a fifth sideways week here, and until these actions stop repeating, then I don't see an end to it. Something will give soon, just not sure when or which way right now. Sugar white premium spread. This continues to yet again be a very colourful chart with many things going on all at the same time. I've previously spoken about two big picture items seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021 highlighted in blue, with the market currently in between the lower time below, currently 82.5, and the middle time above, currently 156.5. Though breached in the past, this is still showing the overall bullish angle of attack. We also have an ascending expanding wedge pattern, highlighted in red trend lines, that has been formed since mid-April to late November, currently 148 even to right off the top of my weekly chart. So far it doesn't really matter. To me it was and still is not the best looking of such wedge patterns, but it is also still there, and it comes with all the possibilities such a pattern can invoke. A sub-point to this has been the monthly key reversal down we saw in September. Despite what has happened since, which seems to justify this selection, please still take this monthly key reversal with a huge pinch of salt, as the earlier monthly key reversal down we saw in July did not work out so well. Nevertheless, it was genuine at the time. The most recent activity has been the small reactionary move back up 3 weeks ago after the prior week's huge counter-to-counter weekly key reversal down, which offset as it did by a country mile the week earlier's weekly immediate countering bullish engulfing pattern, which in turn the week earlier to that, the week's bearish engulfing pattern, just and bear spike. In all this, the recent capping top had been the neckline of the big June 2021 to May 2022 reverse head and shoulders pattern, which I'd highlighted in bright green, currently 144 even. Interestingly, recent action justified part of my commentary I'd made 5 weeks ago, and I quote, "Below the long moving average, currently at 123.5, we have really nothing much until the late April, early May congestion based around the lesser Fibonacci lines at 104.5 and 107.5. The core of this congestion is in the 102 even to 107 zone." End of quote. I continued, and I quote, "So of all these actions and points, it is time to look at possible targets below for the break below the ascending expanding wedge pattern. Thus a potential target X on the downside would be in the 102 zone, just below the late April, early May congestion." End of quote. 4 weeks ago, prices dropped down to reach the primary target at 102. They actually ended up quite a bit way below it due to overrunning. However, I was mindful back then and since that we were approaching the lower time below, currently 82.5, and again highlighted in dark blue, the big 2019 to 2021 bullish Andrews pitchfork, as well as the neckline of the February to September 2020 head and shoulders top, currently 75 3/4, which is slightly below the lower time now, and which I've highlighted in pink. I suspected last week that this one might be important, hence the highlighting. In case you're interested, the secondary harder to reach target X1 for the expanding wedge pattern is way down in the 46 3/4 zone. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.